Hello guys, so it's been some time since my last video and I feel bad about that. I mainly have just been focusing on family life and stuff more recently because I've recently found out I'm going to be a father. So I've just sort of been looking into other things, trying to focus on home life, getting the house sorted and stuff like that. So that being said, I'm still going to be trying to bring you guys videos and keep you updated on all the changes I've been making in my portfolio, which there have been quite a few of. And so I'm sorry if you've missed it, but I'll try and keep you up to date as much as I can. And I'm also going to talk about my thought process with my portfolio and what is going on in the market, because obviously we're seeing lots of different changes. Earnings, some stocks doing really well, like Google and now Amazon, but unfortunately others like Meta and Microsoft may be underperforming slightly, and this is all stuff that I want to be talking about, but unfortunately I'm just trying to keep up as best I can. That being said, there has been quite a few changes with my portfolio. This is one of my two separate accounts that make up the portfolio. This is my Trading 212 account. This is the one I started with. It's where I invest mainly. It's the most user-friendly out of the two and generally is where I keep most of my money. So we've got 59k in here, a total return about £15,000. And some of that has come from realised gains that we have realised on some stocks that we've completely sold out of. Other ones are mostly unrealised gains, so gains that we have yet to sell out of in positions that we hold in the portfolio. And this portfolio is mainly, this individual account is mainly focused on US equities. I have a couple of companies outside of that, like Mercado Libre in this account. But overall, the majority of the percentage of this account is held within US stocks. And the overall value for the portfolios between the two accounts now sits at £76,200. That's well above what we was reporting. I think we had 73k before in the last video, so we've gone up massively and I haven't added anything to it. But obviously when we start getting to higher and higher numbers like this, the overall performance of the portfolio has a bigger impact than sometimes contributions can have. So we're getting towards that sort of level with the amount of money we have now in this account. And our performance against an index wise, we've returned around 8.6% in the past year to date, underperforming what I would compare myself to, which is the S&P 500 ETF that I would invest in if I wasn't invested in individual stocks, and that has returned about 10% year to date. So we're underperforming by about a sort of 1.5% or 2%, and I think that is sort of fair with how I've made some mistakes. I would say Fiserv was a mistake and stuff like that. So I think there's been some companies that I've bought into that I made mistakes with. Other ones have done well, like Amazon, and I'm going to be talking about that shortly. And just to kick it off with my more recent sells and buys and that sort of thing, I sold out of two major positions, I would have said, that since my last update that I should probably cover with you guys. One of them I made a considerable amount of money on, one I lost quite a bit of money on. So I suppose it's sort of a mixed bag, really. ASML I recently sold entirely for around about over £2,000 gain, and I bought it around about this sort of level. We actually bought for, I don't know why it's not showing it, but around $550 around this sort of dip here in March 2025. And we just perfectly timed the bottom. I don't think I could do this ever again, really. And since then, it's now pretty much doubled. We had about an overall 88% gain on that position, and we did really well with it. Now I think it's starting to get overvalued slightly. I think a lot's being priced in with the AI sort of hype that's coming in, and I just sort of see better opportunities elsewhere. So I sort of chose to trim this position. This is my most recent sell, etc., for about £1,100, an overall fill price of £1,081. And it was a size position around 8%, and I sort of took it down, kept on trimming it as time's gone on. And overall, I made a pretty good amount of money from ASML's sales throughout the years. It would have been one I like to hold for the future, but I also saw good opportunities to companies like Topicus and Meta that I would really like exposure to in the future. We have Fiserv, which is another business I invested in around about the 120 mark, so around here. I bought into it, and this has been a mistake that I want to clarify with you guys. Obviously, in my last earnings report, I was quite bullish on the topic, and it's just hilarious to see it in retrospect. But basically, they reported earnings, and their earnings was a complete shambles, to put it in perspective. It was a triple miss. There was no real good parts to the actual earnings reports, and it just sort of fell off a cliff, went down about 50% in the past sort of like week. And it's flipped on its head, sort of everything I thought I knew about the business. And this is quite a good lesson for me to learn, but overall, I think that Fiserv was just one that was outside of my circle of competence. It wasn't a business that I clearly knew well enough to invest quite a bit of money in. I had about a 5% position in it. Overall, I lost around about, I think I sold at the 90s and 80s. So I got out before it dropped even more. But even then, I still lost well over a grand and a grand and a half. So overall, that's my biggest loss to date, and I really want to be introspective about it. This isn't a business that I thought would do that. It has compounded really well in the past, and it just fell off a cliff. And my main reason that I'm sort of seeing is because they keep promising revenue growth to do better. It never does. It was pretty much flat or down 1%, missing by a massive margin of about, I think it was about 9% it missed on revenue actually. EPS missed by 22% in estimates, and it wasn't a thing that I thought could happen with this business because it's number one in its industry. And the only sort of sensible conclusion I can sort of make about this one is the payment processing space is very cluttered. The banking segment, where they don't even have much sort of competition, where they hold number one market share, it clearly is going for a massive transition and change because this hasn't happened in the company's history, and all of a sudden now Fiserv is down 50% in a week. So really overall, Fiserv is a high quality company that I think is having a massive upturn in its overall ability to deliver good shareholder returns, and I don't want to be a part of that anymore. I don't want to look at earnings reports and can't find a silver lining with it. It was probably one of the worst reports I've ever seen, Fiserv's report. So overall, I've sold out of the position. It was a massive loss. Hopefully I'll learn something from it and be more conservative with my buys in the future. Hopefully with buying into likes of Meta and other companies that are higher quality in my opinion, I can maybe do a bit more with performing better going forward. I think if Meta was down by 50%, I wouldn't have felt the same way as I felt with Fiserv. But Fiserv just haven't been able to achieve any earnings growth that has been quite attractive to me in about 2 or 3 quarters that I've owned it. So that's why I sold out of it, and it was a big loss. But I've actually made more on the ASML sale, so I suppose it's sort of flat and neutral on the sales basis. Now, I'm not going to go through all of my positions. There is a couple that I'm going to touch upon now because generally I just want to make these videos really long. Like, I just feel like I'm boring you guys. So I generally, this is how the portfolio kind of looks now. We've got Amazon as our main sort of holding, over 23%. If Amazon continues this run up, I'll probably maybe trim this one. I'm overexposed to it. I really like the business, but they're not shareholder focused. They're more business focused. That's fine because I love to focus on the business, but I kind of want to have a bit of both. So Brookfield Corporation, I'm happy with my allocation. They are shareholder focused as well as business focused, so I really like that. So I'm mindful of that and can keep them at an overweighting. Tasmea is an amazing business. It really is really good. I started off with a 10% position. The rest of it is from gains, and generally speaking, they're doing really well, and I just love the sort of progress they're making. This one is going to continue to outperform, in my opinion, because of the amazing things they're doing. And Topicus is another amazing business that I've recently been buying a lot into. So these two positions have massively sort of come out of nowhere in the portfolio. So I want to talk a bit more about them. The rest have all come from somewhere apart from Meta, which I'm going to be talking about as well. So biggest position remains Amazon at 95 shares, an overall value of about £17,655. And we've made about 4,400 in unrealised gains for this one. That's mainly because of the recent run-up surrounding after its more recent earnings report, which was really good. And we saw lots of good things from Amazon. Net sales increasing to 13% in the third quarter to $180.2 billion. Overall operating cash flows increasing by 16% to $130 billion in the trailing 12 months, which is really good to see, a re-acceleration from the 12% we were sort of sitting at last quarter. Free cash flow sort of remaining flat, mainly because there's so much expenditure going on with capital expenditure. I think their capital expenditure is increased massively to around over 100 billion expected, and this is just because they're seeing such a good opportunity with AI, supposedly. Now, how that plays out, I don't know, but what I do know is that Amazon's going to still be able to switch on that, flip the switch on their free cash flow and return it to shareholders at any point. They're reinvesting in the business because they see potential. And I like that because it means that they're not stagnating in their growth. They continue to see opportunities, just as all the Magnificent Seven sort of are with this opportunity. And Andy Jassy had a really good sort of bit here, which I quite liked from him because he was getting a lot of flack surrounding AWS's growth, which had maintained around 17%, which is still very fast given their overall sort of size compared to the other ones. I think it's close to nearly both Microsoft and Google combined, so it is a very big part to play as AWS is sort of lead in cloud. But Andy Jassy was getting a lot of flack for this, saying that they're not accelerating as quickly because the other two are growing massively faster. And fortunately, AWS grew by 20% compared to the Wall Street's analyst expectations around 18%, and the overall market's low expectations for AWS going into this quarter. And so it accelerated to 20.2%, and he said, "We continue to see strong momentum and growth across Amazon as AI drives meaningful improvements in every aspect of our business." And he also went on to say AWS is growing at a pace we haven't seen since 2022, re-accelerating to 20.2% year over year. And they can see, go on about talking about the AI demand remaining strong. They've added 3.8 gigawatts of sort of overall sort of capacity, if you like, in the last 12 months, which is just a staggering amount. And this sort of tells you that basically that Amazon's still improving upon itself and it's still seeing a higher demand than what they can currently supply. And if they can build that supply out, as they are doing with capital expenditure, we could see those growth rates continue to accelerate. I don't think many people are really talking about how Amazon is really not just an AI-focused cloud business, even though AWS is now the focal point for every single investor. The business is more than that. It's a robotics business as well. They've now recently talked about replacing 60,000 US jobs with robots by 2033. And what's interesting is Tesla is always trying to push this narrative that they are the sort of they're the only ones that can really bring robots into the world, essentially. They're the only ones that can produce this sort of technology, and Amazon's trying to sort of downplay it. They're trying to talk about it as if it's just something that's happening as a sort of normal, obvious stepping stone of their business. And that's mainly because they're not trying to get people not to boycott their business or hate on them, because they're getting rid of jobs, making the business more margin efficient without necessarily having to deal with all of the flack that comes from that. Because obviously people get annoyed, people talk about them being a monopoly, an industry that hates workers, and people don't want to work for them, and they sort of rebel against it. So I think it's interesting because Amazon's not really talking about the robots, but Tesla is, and Tesla's share price is shooting up based off this narrative, whereas Amazon's hasn't really got to that narrative yet. And sort of the robots aspect is going to massively help Amazon's margins and make them a really profitable business potentially in the future. Now, Tasmea is just an amazing business, and There's lots to like about it. They are essentially a sort of maintenance and engineering company. They offer services that are specifically based around sort of mission critical infrastructure, and their revenues are about 95% recurring. So it's happening every year. They're really predictable in their growth rates because it's not cyclical in nature, which is really nice and what I like about the business. Here they've got a 600 million to be delivered in 2026 on their record earning books. That's the highest number of orders they've had. So they're doing more business. Their earnings growth grew by 32% this year. So NPAT, which is essentially their own form of earnings, is probably the best metric for them to use, really, given looking at everything. It's guided for 70 million this year, and they're gonna beat it by far. They're gonna outperform this guidance easily because they've made an acquisition in that time frame, which is going to show up next quarter, and they record every 6 months. So they obviously report what effectively is 2 quarters worth, sort of biannually, and the last year they had 53 million. So this is a business that's growing at over 30%, and they're beating that guidance. And that was raised from around about 62 million guidance around a year ago. So they've gone up by about 7 million, and they're going to beat it anyway. So they're revising upwards in their guidance, and they're still smashing it. So that shows how well they're doing in terms of earnings. They're really cash flow positive, and they generate a lot of cash flow from their EBIT. So their EBIT margins to operating cash flow is essentially 100%. They just, whatever they make in EBIT, they convert. That's just the way to look at it. So operating cash flow is EBIT, essentially. And they're an industry leader in most of their spaces. They do make acquisitions alongside their normal levels of growth, and that is really helping to bolster their moat overall, and it's really good to see in this business. Their overall revenues on the top line are growing by 37% as of last quarter. Their EBIT margins sit about 13.6%, and EBIT so far is sitting at about 74.4 million. And what's interesting is this is all with returning shareholder value. Shareholders are mainly insiders own about 60% of this business, so they're really shareholder focused. They've got a massive incentive to reward me as a shareholder. So that's why it's such a big part of my portfolio, over 10%. And when we look on the graph of how they're growing in their EBIT, they've got a 33% CAGR over the past 5 years in EBIT, and they're going to beat 32% this year. And they're not even really guiding for it. They're given 15% as a sort of low-end organic growth that they expect. And then they just make really good, sizable acquisitions that are really helpful to bolster their moat. Their NPAT has actually grown by 53% statutory, and they do a lot of dividends as well. They've got a 53% CAGR in dividends over the past 5 years. A lot of that has come in the past year because they're now a private held company. And this was mainly because of a special dividend that was here, but overall, it's a massively good growing trend. I don't really like the dividends aspect personally because I don't benefit it massively from a tax perspective, but if they want to effectively give me really good return on invested capital, as they are, and still provide me with a dividend, that's really good as well. So overall, I really like this business. It's an amazing sort of operating business that just does really well in all of its industries, and I'm really liking its sort of future potential in terms of revenue growth and stuff like that. So they're saying by 2026 they're going to have over 600 million in the pipeline, essentially, and earnings are just going to go through the roof because it's a really profitable recurring revenue stream. So I really like this business. It's over 10% of the portfolio. I expect it to remain there and probably increase from there organically, and I don't intend to necessarily add at the moment because I'm seeing other opportunities as well. And then we've got Topicus, which makes up about 9 to 10% of this overall portfolio now. We're down a little bit on our position, around about 5% or so. And Topicus is one that has recently gone on a massive dip. And that was because it was trading for highs around 140 odd in July 2025 at its peak. Since then, it's now down to the hundreds, $98. And this is obviously the American held ticker, which is the only one available on Trading 212. And I love this business mainly because it's got a history of outperforming. It's a spin-off of Constellation Software, has their playbook but in Europe, and essentially what they do is they acquire businesses that are highly margined, software businesses mainly in Europe, and they use that to create cash flow, make efficiencies in the business using some of that cash flow, not really investing in organic growth and using the cash flow they make from that business for years to come to buy new businesses. And it's a flywheel that just keeps on coming. And Constellation Software has done very well over time in doing that approach, and now Topicus is along that path and doing very well. But there's a lot more of a runway for growth with Topicus because it's so much smaller. I think it's just under half of what Constellation Software is, if not more. And it's got really good runways for growth into the future, especially in the European markets. And Topicus is one that is just growing well on every front. It's growing its top line revenues by around about 20%. Its operating cash flow and free cash flow are next to the same. And their free cash flow is growing by around a 23% CAGR in the past 5 years. Now, I don't expect those sort of levels to go forward. I expect around 20% growth. But it's currently trading for around about 25 times free cash flows, and it's growing about 20%. Now, that may seem like, well, you're sort of overpaying a little bit then, but relative to some of the big companies, no, and relative to Topicus' averages, no as well. It's sat closer to about a 30 times multiple in the past. If it can regain that and continue to increase as it is expected to, I could see this being easily a 20% return from here. And despite this 5% organic growth that they've got here, it mainly comes from acquisitions. And them being such a profitable business that is on and managed by, I mean, they have the CFO as that's the same as Constellation, so they're effectively the same management team as Constellation. And with Mark Leonard recently coming away from the business of Constellation Software, this business started to take a hit and hasn't really stopped. Now, there could be a sell-off coming up in earnings, which I would be happy to take advantage of, but we'll have to see. Sometimes it usually sells off after the fourth quarter and picks up in the first quarter, mainly because they get the majority of their free cash flow in the first quarter of the year. So that would be around about this sort of time in April when we saw this recent run-up. So we could see that happen again with Topicus, but we'll have to wait and see. And just on the front of what Topicus is really capable of, if we look at, this is from the Patient Investor, who's an amazing investor that I sort of follow. This is the price performance of Topicus and Constellation Software. So this is Constellation Software specifically, but if we look at how well they have compounded throughout the years, we're sort of getting an insight into what's going to happen with Topicus potentially. $10,000 in 2008 invested in Constellation. After around about, I think that's it's around about 23-year window. No, 14-year window. 13 or 14-year window. Is sitting at $823,000. Just an amazing growth. Return rates for the years sitting at 44%, 50%, 60%, 92%, 56%, etc. And it goes on. This is sometimes due to margin expansion, but when a company can demonstrate they can be this good at compounding their own capital and allocation, have got a sort of business segment that's doing really well in vertical markets. This is the outcome, an amazing potential compounded return, and that's what I'm hoping to see with my buy of Topicus. It's a core holding that I hope to keep around 10% in the portfolio. Now, the final stock I want to talk about in this video, despite talking about all of these that I could talk about for ages, is Meta Platforms, because this is just a very recent buy. Just yesterday I bought around £4,000 of the stock. It's about a 5% position, and I want to talk about my reasons why, when I haven't really talked that much about Meta before. But they are an amazingly execution business. They do really well in the past, say, year or so in their earnings reports. Every earnings report that comes out for Meta, I'm really impressed by. They always beat on the top and bottom line. Most recently, they didn't, and that was because of a one-time sort of tax thing with their EPS, which wasn't the reason for the sell-off. The reason for the sell-off was because they said they were going to do more in capital expenditure. Next year, that is, sorry. Now, to me, that's not necessarily a problem if they are getting a good return on invested capital, which is always the question. But I think Meta specifically is one of those businesses that is going to continue to outperform in the market. It's the cheapest of the Magnificent Seven stocks now, and I just think that this is an opportunity that I couldn't really see just go by me. If we look over the past, say, like since 2022, has there been an opportunity to buy here? Maybe on this dip here in April 2025 when it went down to $500. But other than that, you can't really buy it at a good dip until now. So in the past 3 years, this company hasn't dipped at all other than one time. And that was a good buying opportunity. So maybe this is the same again now. But it's now around about 8 shares or so. And I want to talk a bit more about this one, but I just want to touch upon its current valuation, really, because I think it's not really being overstated. Meta's price to earnings is sitting at 23, whereas some of the other ones, their forward price to earnings for big tech, Apple's sitting at 35, Nvidia 34, Microsoft 34, Amazon at 33, which I still think is a pretty good price. Alphabet 29, which I think is now getting on the more extended end. And Meta, which is 23. There's a massive difference between all of these and Meta. And I think that this forward price to earnings is unlikely to continue going forward. And looking more towards their financials rather than their price, we can see that they really can demonstrate their top line revenue growth that has gone up by a CAGR of about 27% and is still growing by around about 26% now and doesn't seem to be slowing down massively. So it's growing nearly the fastest out of all the Mag 7. I think that is the fastest, actually, thinking about it, in terms of top line growth. And then cash from operations, specifically, rather than free cash flow because of their higher capital expenditure, it's just exploding from here. We're sitting at 91 billion in the past 2024. And it's not slowing down. It's growing at a CAGR of similar to the revenue. So if we're looking on a revenue basis and cash from operations, they're growing at about 26% in cash from operating activities. And they're currently trading for around about 15 or 16 times price to operating cash flows. That's really cheap. Their EPS is growing by around about over 20%, and they're trading for around 22 times earnings. So I'm seeing a lot of potential with the likes of Meta, and hopefully I can translate that a little bit in terms of showing you guys what a possible return could be for this stock. With like conservative estimates on what I think Meta can do in the next 5 years with its earnings, if it grows its EPS by around about 15% over the, say, next 5 years, and they continue to buy back a less amount of shares because that's what they did in the last earnings report, they bought slightly less because they're seeing more opportunity with AI, and then they keep their price ratio of the past 5 years, which is likely if they can reaccelerate growth and keep growing at these sort of levels, then we get a CAGR for the stock of around about 13% from here and a fair value of $751. And the share price currently sits at around about 651. So do I think it's a screaming buy? No. But do I think it's an amazingly high quality company trading at a fair valuation? Yes, I do. And I do think that if it continues to go down, say even to these sort of points in April, we could really be seeing a very good opportunity to buy. And I certainly would be exploiting that if it continues to go down. But I have to wait and see. I just thought I saw a good opportunity here with this one. But I do think that overall my positions are sort of looking pretty good in the fair value to undervalued range. And the S&P 500 just looks quite overextended to me. me. So I don't know what you guys think, but I'm hopeful to see this portfolio grow into the future. If you did sort of like me showing you through it and walking through it, want to see more videos like it, please like the comment and subscribe, because it really does help me out and keeps me motivated to kind of trying to keep bringing you guys content. When people are asking me questions and comments, I'm thinking more about the YouTube channel, and I want to give you some more content to chew on. But thanks for watching, and I'll catch you in the next one.